Hello students, in this video lecture, I will be introducing our course that is Financial Accounting. Financial accounting is a specialized branch of accounting that tracks a company's financial transactions. Using standardized guidelines, transactions are recorded, summarized, and presented in a financial report or financial statement such as an income statement or balance sheet. Companies publish financial statements according to current calendar. The declarations are considered external because they are given to people outside the company, the main beneficiaries being the owners or shareholders as well as some lenders. However, if a company's shares are publicly traded, its financial statements tend to be widely disseminated and the information will likely reach secondary recipients such as competitors, customers, employees, labor organizations, and financial analysts. Before getting deep into accounting, let's take an example. Suppose Mr. A wants to start a business, so he will have to arrange funds to invest. This is called capital. Also, he would require money to acquire assets for manufacturing goods to be sold on cash or credit basis. And the last thing to be done is keeping the record of business transactions. To keep a record of all business transactions, he will maintain his books of accounts according to the bookkeeping process. While recording, summarizing, and presenting financial reports, a businessman faces various problems. Some of the problems are related to recording financial transactions, decision making, and calculation of cost. Also, a businessman has to make sure that he prepares books of accounts according to bookkeeping process. For various types of information which are required in accounting, he will use other branches of accounting like financial accounting, cost accounting, management accounting, inflation accounting, and human resource accounting. Now, let's move on to the definition of accounting. According to American Accounting Association, accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decision by the users of the information. The textbook definition of accounting states that it includes recording, summarizing, reporting, and analyzing financial data. Let us try and understand the components of accounting to understand what it really means. First one is recording. The primary function of accounting is to make records of all the transactions that the firm enters into. Recognizing what qualifies as a transaction and making a record of the same is called bookkeeping. Bookkeeping is narrower in scope than accounting and concerns only the recording part. For the purpose of recording, accountants maintain a set of books. Their procedures are very systematic. Nowadays, computers have been deployed to automatically account for transactions as they happen. Next one is summarizing. Recording of transactions creates a raw data. Pages and pages of raw data are of little use to an organization for decision making. For this reason, accountants classify data into categories. These categories are defined in the chart of accounts. As and when transactions occur, two things happen. Firstly, an individual record is made, and secondly, the summary record is updated. For instance, a sale to Mr. X for $100 would appear as sale to Mr. X for $100 and increase the total sales from $500 to $600. That means the sales have increased by $100. Next one is reporting. Management is answerable to the investors about the company's state of affairs. The owners need to be periodically updated about the operations that are being financed with their money. For this reason, there are periodic reports which are sent to them. Usually, the frequency of these reports is quarterly, and there is one annual report which summarizes the performance of all 4 quarters. Reporting is usually done in the form of financial statements. These financial statements are regulated by government bodies to ensure that there is no misleading financial reporting. And lastly, analyzing. Accounting entails conducting an analysis of the results. After results have been summarized and reported, meaningful conclusions need to be drawn. Management must find out its positive and negative points. Accounting helps in doing so by means of comparison. It is common practice to compare profits, cash, sales, assets, etc. with each other to analyze the performance of the business. So, this was all about the introduction to financial accounting and an example of accounting. Thank you.